President Mary Daly. President Daly, thanks for joining us. I don't know which of you guys got the better deal. John got the gold in the basement, but you got San Francisco and the bridge and the weather. So I'm not sure who got the better deal there.
Look at the background here. I'm in pretty good shape.
Exactly. Thanks for joining us.
My pleasure.
Tell me how you react as a Fed. Tell me how you react as a Fed official who I assume is looking for the economy to slow. But you see robust retail sales this morning, and of course there was that robust discussion among the anchors of the show about just what exactly is going on with retail. Do you want to see the consumer continuing to spend more?
What I'm looking for is for monetary policy to work and do its job. We're raising interest rates, and we've seen interest-sensitive sectors, housing notably, come down, and that's a really good start. The consumer is hanging in there, as you saw from the October numbers, but when I talk to my contacts, I have 9 Western states. I spend a lot of time out there talking to businesses, large and small, consumers, workers, community groups. And what I'm hearing is that consumers are stepping back. They're changing how they allocate their spending. They're dealing with high inflation, of course, so they have to make trade-offs and put things back that they would otherwise get. But they're also preparing for a slower economy, and that's a very good start. We're not there yet, obviously, but that's exactly what we'd want to see. We want to see the economy slow down, bring demand back in line with supply, get inflation down over a reasonable time period, and get back to a sustainable pace of growth.
So we just got some inflation numbers. They were both better than expected. I know they're only 1 month's worth of data, and you want to see a lot more than that. But when you look at the numbers that we got, is there anything inside the inflation dynamic that you're looking at that tells you things are moving in the right direction?
Sure. One of the things that I looked at in the CPI is the change in core goods inflation. For a long time, we've been saying that that's material. We want goods and service spending to rebalance, and we want to see goods inflation come down, both as demand is pulling back, but also as supply recovers. And I saw that as a positive news. You're absolutely right. 1 month of data does not a victory make, but those were some positive signs, and you see it in the PPI this morning. So these things getting better are encouraging, as is a slower labor market, if you think about it. But we need to get more of that to be sure that and confident that inflation will come down to our price stability goal in any reasonable amount of time.
In journalism, President Daly, we like to say you need 3 items to make a trend. Am I right to think about 3 good months of inflation data would be enough of a trend for you to maybe pause?
Well, pausing is off the table right now. It's not even part of the discussion. I'd say right now the discussion is rightly in slowing the pace and putting the pace discussion in the background, focusing our attention really on what is the level of interest rates that will end up being sufficiently restrictive. So I really want to turn people back to the statement we released, to Chair Powell's press conference, which I think just reiterated some of the aspects of the statement that really focused on pace was the conversation of the first phase of tightening, and that has been completed. We're in a slightly restrictive space by most people's calculation. Now we're really talking about the level that is sufficiently restrictive. That means data dependence, extreme data dependence, thinking about the cumulative tightening we've already put into the system, and of course those lags in monetary policy that become really important if you're trying to gauge exactly how you get somewhere without over or underdoing it.
I don't want to make fun of this, but if pause is off the table, is it maybe in the kitchen getting prepared in the following way? If you raise 50 in December and go another 25 in January, that means you could be at the end of a rate hike cycle at the beginning of January, maybe March. That's something I can see forward. Is the end of this very aggressive rate hike cycle potentially in sight here early next year?
Well, the way I look at it, and so let me just say where I think we're headed. I've been a little more on the we'll probably have to go higher side. I don't usually disclose my dots for the SEP, so don't get used to it. But in September, I really thought when I was looking at the economy that the likelihood we'd have to go to 5% was strong enough that I wrote that down. I still think of that as a reasonable ending place for us before we hold. And the holding part's really important. It's a raise to hold strategy. But if somewhere between 475 and 525 seems a reasonable place to think about as we go into the next meeting. And so that does put it in the line of sight that we would get to a point where we'd raise and hold. And I want to just make one point that isn't often talked about. When we raise and then hold, over time as we're holding, monetary policy is becoming tighter as inflation comes down. And so that's another factor we'll have to consider. So the discussion squarely today is in the idea of how high do we have to go, and then it will turn to how long do we have to hold it.